In this video, we will explore the investment philosophy of the renowned investor Warren Buffett, as presented in the book The Warren Buffett Way, authored by Robert G. Hagström. The book delves into the investment strategies of Warren Buffett, perhaps the most successful investor of all time. The book outlines the principles and techniques that Buffett uses to pick stocks and build a successful investment portfolio. The author examines Buffett's background, investment philosophy, and his approach to analyzing financial statements. The book also covers the importance of value investing and the value of patience in the stock market. Overall, the Warren Buffett Way provides a valuable insight into the investment strategy of one of the most successful investors in history. If you want to apply the Warren Buffett Way to your own investments, be sure to check out the links in the description below for exclusive deals on investment resources. Alright, let's dive into the top 5 key takeaways from the book. Takeaway 1. Invest in what you understand. Investing in what you understand is a cornerstone of Warren Buffett's investment philosophy. He believes that investing in companies and industries that you have a good understanding of is crucial for success. This means avoiding investments in companies that are outside of your area of expertise or knowledge, as this can lead to risky decisions and potential losses. One example of Buffett's approach to investing in what he understands is his investment in Coca-Cola. Buffett understood the soft drink industry very well and saw the potential for Coca-Cola to maintain its strong competitive advantage in the market. He believed in the company's brand power and its ability to generate long-term value for its shareholders. Buffett's investment in Coca-Cola has paid off handsomely over the years as the company's stock has continued to grow and generate strong returns for investors. By sticking to his strategy of investing in what he understands, Buffett has been able to identify a high-quality investment opportunity and capitalize on it for the long term. By investing in what you understand and know well, you can reduce the risk of making uninformed decisions and increase your chances of identifying high-quality investment opportunities that can generate strong returns over the long term. Takeaway 2. Long-term thinking pays off. Buffett's emphasis on long-term thinking is not only about patience, but also making informed decisions based on fundamental analysis of a company's potential for sustained growth. He believes that by focusing on the long-term prospects of quality companies, investors can reap the rewards of compounding returns over time. This is why he often advises against attempting to time the market or chase short-term gains. For example, in the case of American Express, Buffett's long-term approach paid off handsomely. Despite the initial scandal that caused the stock price to plummet, Buffett saw the underlying strength of the company's business model and brand. He believed that the company's strong competitive position in the credit card market would eventually lead to growth and profitability. Over the years, Buffett's faith in American Express was more than justified. The company's stock price soared, and Buffett continued to hold on to his investment, even through market downturns and economic crises. His patience and conviction paid off in a big way, and American Express became one of his most successful investments. Overall, Buffett's approach to long-term thinking is a key takeaway for investors looking to emulate his success. By focusing on the fundamentals of quality companies and holding on to investments for the long haul, investors can potentially see significant returns over time. Takeaway 3. Buy companies with competitive advantages. One of the most important lessons that investors can learn from Warren Buffett is the importance of investing in companies with sustainable competitive advantages. According to Buffett, companies that have a competitive advantage are much more likely to thrive in the long run and deliver superior returns to investors. There are several factors that can give a company a competitive advantage, such as a brand, unique intellectual property, or a well-established distribution network. One company that Buffett invested in because of its competitive advantage is Apple. Is a prime example of a company that has built a strong brand and a loyal customer base, which has allowed it to maintain its position as a leader in the technology industry for decades. By investing in Apple, Buffett recognized the company's potential for continued growth and profitability based on its strong competitive advantage. Companies with a competitive advantage are better equipped to weather economic downturns and market fluctuations. They have a loyal customer base that is less likely to switch to competitors, and they are often able to command higher prices for their products and services. This means that companies with competitive advantages are able to generate higher profits and returns on investments, which can lead to higher stock prices and dividends for investors. Takeaway 4. Price is what you pay, value is what you get. Buffett's investment philosophy emphasizes the importance of understanding the true value of a company, rather than simply focusing on its stock price. As he famously stated, price is what you pay, value is what you get. This means that he places a higher value on finding quality companies with strong fundamentals that are trading at a fair price. In fact, he believes that investing in a company that has a great value proposition, even if it's trading at a slightly higher price, is a better strategy than investing in a company with a low stock price but poor long-term prospects. Buffett's investment in Geico is a classic example of this principle in action. In the 1950s, Geico was an undervalued auto insurance company that was struggling to stay afloat, but Buffett saw something in the company that others didn't. He recognized the intrinsic value of Geico's business model and its potential for growth. Instead of being deterred by the low stock price, he invested in the company and held on to his investment for decades. Over time, Geico grew into one of the largest and most successful insurance companies in the world, and Buffett's investment paid off handsomely. The point is that investors need to be willing to do their homework and understand the true value of the companies they are investing in. They need to look beyond the stock price and assess a company's fundamentals, including its financial health, its management team, its competitive advantage, and its growth prospects. By taking a long-term view on focusing on intrinsic value, investors can increase their chances of success and build a portfolio of quality companies that will deliver strong returns over time. Takeaway 5. Choose quality over quantity. Buffett's investment philosophy is centered around choosing quality over quantity. He believes that investing in a few high-quality companies with substantial competitive advantages is much better than diversifying across many average ones. Buffett has often cautioned against excessive diversification, believing it can dilute returns and limit the potential for substantial gains. One of the ways that Buffett has demonstrated his preference for quality investments is through his concentrated portfolio. Buffett has focused his investment on a select number of companies, including Coca-Cola, Apple, American Express, ConocoPhillips, Geico, etc. By concentrating his investments, Buffett can closely monitor and understand the companies in his portfolio, making informed decisions and adjustments as necessary. This approach has proven successful for Buffett, with many of his investments achieving long-term growth and substantial returns. By choosing quality over quantity, investors will be better equipped to build portfolios of strong, stable companies that will perform well over time. Conclusion. In conclusion, Warren Buffett's investment philosophy is grounded in common sense, discipline, and a long-term perspective. He believes that investing is not about getting rich quickly, but about building sustainable wealth over time. By investing in quality companies with a competitive advantage, strong management, and a proven track record of performance. By taking the lessons from the Warren Buffett Way to heart and adapting them to your own circumstances, you can develop a more informed and disciplined approach to investing that can help you achieve your financial goals over the long term. To learn more about how you can secure a financial future, check out the next video popping up on your screen right now.